Good afternoon, everyone. Welcome to today's session, Breaking Barriers in Investing, Myths, Mindsets, and the Power of Participation. My name is Denise, and I'll be your host for today's conversation. Please help me welcome Jennifer Stevenson, Vice President and Portfolio Manager at Scotia Global Asset Management, into our conversation. Jennifer brings more than 3 decades of experience in the investment industry with deep expertise in that global energy sector. Her work spans across both traditional and evolving areas of energy, and she has spent much of her career navigating all of these complex, fast moving markets, which makes Jennifer's perspective particularly valuable in her ability to connect these real examples, her experience, and add that value that we're looking for today's discussion, especially when it comes to staying focused through these market cycles and building long term confidence in investing. So, without further ado, let's welcome our guest speaker into this conversation. Thank you so much for taking time out of your afternoon to spend the hour with us. How are you doing today?
I'm doing great, Denise. I'm really happy to be here and talk with investors about what's going on in the turmoil that surrounds us.
That's amazing. And again, we appreciate this so much. And I'd love to just start things off to get to know you a little bit more about your role as a vice president portfolio manager at Scotia Global Asset Management. What does that mean? You've spent so many years working in the investment industry as well, across multiple cycles. How has that experience shaped the way you think about investing and long term participation in the market?
So I've always been in the energy sector. I did my undergrad and my master's degree at in Alberta, one at U of C and one at U of A. And my first real job after I worked at a bank in high school was working for an oil company. So I worked for a few different oil companies, and then I got transported into the financial side. So I've always invested in energy companies, been in the energy business. And I think the really key thing is when you think about markets and investing is to understand that it's a long-term business. It's a long-term commitment if you want to be successful, because there's lots of hype and noise and chitter chatter, but the people that are successful take a very professional, long-term, I would even call it boring view of it, because it's important. It's your money, right? So you just don't want to do anything rash or crazy or unfounded. And if things are feeling risky and not fun and not valuable, there is nothing wrong with having cash, putting it in a savings account. Like, that's okay too. You don't always have to be 100% invested. So I just think long-term quality and be calm.
I agree. And, a significant portion of your career has also been spent working in that global energy sector, like you shared, which is often viewed as one of more of a cyclical or a fast moving area when it comes to the markets. How has operating within such a dynamic industry influenced the way you approach volatility, uncertainty, in these long term investments thinking?
Yeah, the interesting thing about the energy business is it's definitely cyclical, because you go through periods where there's less production and less supply, so prices go up, which then gives the companies the cash flow to invest in drilling and create more production and more supply, and then that has an impact on price, right? I mean, supply and demand impact price. That's pretty fundamental. When there's more supply, generally the price is lower, and vice versa. So within the energy sector itself, though, there's different parts of it that react to the supply and demand and price function at different times. So there's companies that produce oil and gas, but there's companies that process it. There's companies that transport it in pipelines. There's shipping companies, and there's users of the oil and gas, like power companies. So in a cyclical industry, which really refers to the price and the production side of it, you can be invested in it in different facets of the industry and not expose yourself to as much volatility as the industry goes through its cycles. And the cycles are long term too. It's not like they're 6 or 12-month cycles, like they're 5-year cycles, really. And there's always volatility. I mean, any day there'll be something in the headlines that somebody reacts to in the market, and you really need to understand that the energy sector for sure, and other sectors too. I mean, tech nowadays, even consumer discretionary nowadays. But if you just spend too much time looking at headlines and tweets and bits of noise like that, you're just going to focus too much on that and lose sight of what you're fundamentally doing, which is looking after the long-term growth of your hard-earned money.
I see. And like you mentioned, it's usually longer periods of time, not just that short time frame that we're looking at, especially nowadays when there's so much buzz in that sector and industry.
I mean, everybody has access to putting in a comment or a tweet or a social media post or getting on the news and saying something that a lot of times is really not based on fact. So I spend a lot of time reading and talking to people who know the facts, who analyze the molecules, who can tell me what's really going on, and then I can make judgments and make investments in our mutual funds for our clients that way, because the noise drives me bonkers. Because if you just looked at the noise, you'd get a really distorted view of what's going on, truly.
Well, today's session focuses on the idea of breaking those barriers of investing, particularly in those beliefs or preconceptions that may discourage people from participating. From your perspective, why do certain myths about investing continue to persist? Or why do they sometimes have such a strong impact when it comes to women or other unprecedented groups in this investing space?
Yeah, that's such a good question, because I just find when people talk about the markets, if they invest in the markets, they only ever tell you the good stuff, right? If they made money on 2 stocks or 2 funds or 2 ETFs or 2 whatever they bought, they're going to tell you about those 2. If they lost money on 8, they don't tell you that, right? So you get a really biased report from your buddies or from social media posts. So you have to understand that it's not easy, because it's a long-term undertaking. And there's lots of technical jargon that people throw around, and it sounds really intimidating. And each industry has its own language. Like oil and gas is ridiculous, right? I mean, it sounds like we're speaking a completely foreign language sometimes when us nerds talk to each other. But you can figure that out. You can read, like there's great information that's free to access, whether it's on the stock market, you know, from you guys, like from us at Scotia with iTrade, from the securities commissions, from other consumer focused groups that are just educating people. Like Canada's got a Canadian Securities Institute that they put out lots of information that's just, you know, what is a cash flow statement? What is a balance sheet? Like you can read it. And you know, you have a checking account, you have a savings account. It's kind of like what companies have too, right? Money comes in, money goes out. They make investments. Like you buy a house, they might drill an oil well. You get a paycheck, they get revenue from selling their product. So you can put it in context and figure it out. And then it's just a matter of putting in the time to do that reading and that education. So then if you want to invest in stocks yourself, or you want to invest in mutual funds yourself, or sector funds yourself, then you're making an educated allocation of your money, of where it's going. And then when you see things on the news, you can put it in context and say, I think that sounds valid. Does that make me want to invest more or less in this area? Or I think that sounds like noise, and I'm just going to let that rush off because it doesn't matter. It doesn't impact my long-term view.
Now let's take a look at unpacking some of these myths that we want to chat about. Many of these beliefs can feel convincing, even when they're not fully reflective of how the markets behave over time, especially nowadays where we can be essentially experts at anything when we see it all on the news or on these tweets or on social. Why do you think certain investing myths tend to resonate so strongly with individuals who may be newer to investing or maybe still building confidence in the markets?
Yeah, I find that there's so much social media hype, and again, everybody talks about what worked, and you know, Bob said he bought XYZ stock and he made 30% in 2 days. That's fun for Bob if it's true, but he doesn't tell you about the 8 other stocks that he lost money on. So net, is he ahead in his portfolio? We don't know. So I think it's really important to just focus on quality and duration. So you want to invest in things that are long-term, and you want to make sure that you are recognizing that you're making that investment with a long time horizon. Because I mean, you can sound exciting like the day traders or the hedge fund people that are on your socials, but the guy that a lot of professional money managers look up to as being a long-term value creator is someone like Warren Buffett.
Mm-hmm.
Well, he's boring. It's awesome, right? He buys companies and he holds on to them for a long time, and they pay him dividends, and those compound over time. So compounding is huge. Dividends are great. Even when this price of a stock or the net asset value of a mutual fund goes up and down, you get those dividends every month, every quarter, every year, however often they're paid, and you just compound that. The power of compounding is amazing.
I like that. So stay focused on duration, on your time frame. Those are some good grounding things to really try to myth bust those some of those items here. Okay. Another thing that we constantly surround ourselves with is financial headlines, social media commentary, market opinions. There's so many different channels out there. How can this level of information influence the way people interpret markets? In some cases, it reinforces common investing myths or misunderstandings. How can we approach this?
The volatility in the markets, I think, has really changed over time. Like, it's increased over time because there's investment money that reacts to the news of the day, the news of the hour, the news of the minute.
Mm-hmm.
So something happens and commodities or stocks react. And that's not the big professional money managers. That's not us doing that stuff. That's people with different objectives, people that day trade, that are flipping a stock to make a dime, that sort of thing. And it's people that sector weight, and they're just shuffling the weights among different sectors based on headlines. And those are all unique and can be valid investment strategies. But I think for individual people making investments, you want to understand why you're in a particular fund or ETF or stock, and just think to yourself, does that headline this hour change why I bought that stock? Am I still confident that that's the right stock, or that's the right fund, or that's the right sector to be in? And if it doesn't change anything, like it doesn't dramatically impact the reason you bought it in the first place, then leave it alone. And if you're worried about the risk in the market entirely, like I said at the beginning, there's nothing wrong with having cash. You may not make as much of a return if it's in your savings investment account as in the stock market, but if it gives you peace of mind, or can also give you dry powder to invest when things look really bad and you think, I think this might be a good time because I think long term things will improve, then you've got the dry powder to invest. So it can give you some stress reduction, some buffer, and then also some opportunity as well, having that cash investment account type of flexibility. And then again, just focusing on what's really going on and if it impacts your investment decision.
We'd all love to get to know your mindset and discipline approaches a bit more. Over the course of your career, managing different portfolios as well as navigating different market cycles, you've likely experienced periods where markets moved really quickly or unpredictable. Can you share an example that illustrates how maintaining discipline or staying focused on a process played an important role during these moments?
Yeah, COVID was a big shock, right, to everybody. I mean, the world shut down, and that when I look at the energy sector, for example, when you look at energy demand over time, it just goes up, and as you narrow in, there's little periods of volatility, but it's up and to the right. And the only time in the last decades that we've had an actual reduction in energy consumption, oil in particular, was COVID. Well, we all know why, right? We didn't fly anywhere, we didn't drive anywhere, nobody was shipping anything anywhere, we were hunkered down. So when something like that dramatic, for me, managing mutual funds in the energy sector, my funds were 40% cash. So why did I do that? I did that to just protect the investors against risk because we didn't know how long this was going to play out. I just think you just, again, just have to be confident what you own and protect yourself against risks and take advantage of things like dividends where the companies are generating cash flow and giving it to you.
Yep, absolutely, especially when it came to COVID and even times now, market volatility has tested even the most experienced investors. When markets become particularly uncertain or you see these headlines that turn negative, what perspectives or habits can investors add to remain grounded and focused on long-term thinking?
Yeah, it's when the headlines are just, shooting a fire hose at you, right? About this, that, and the other thing. And the news is always bad, right? Like that's what gets the clicks, is it telling you bad stuff. So I always like to talk to, in my case, talk to the companies about what they're doing, or as an individual investor, like you can go on companies' websites and read what they're doing, read what they're doing in their business, read what they're doing in the community, because they're doing good stuff. And again, think about what is going on from a long term, like for example, in energy, we look at things that drive ongoing increases in demand for energy. Well, that's population growth, improving economies, improving standards of living. Does the current situation decrease any of that? No. I mean, things will shift around, pricing will change things a bit, but that undercurrent, that long-term tailwind is still absolutely intact. So just taking a step back and grounding yourself, I think, is always really, really important.
No, those are some great points. And I like how you said it's good to understand what investments you're investing in. So understanding what the company's coming from versus just the headlines is a great area to start. Now that we've talked a little bit about myths, we understand some of these mindsets and disciplines. I'd love to look into navigating all of these complex sectors or these volatile areas. Some sectors of the market, for example, like energy and oil, can appear particularly complex or volatile to many of us. Based on your experience working closely with these industries, what are some characteristics that define sectors like this and make them unique within all of this broader market?
Yeah, I mean, the thing that I like about the energy sector, I mean, it's got its own language, right? I mean, I could have a conversation with you and say all kinds of words that the rest of, like, we wouldn't understand, because it's technical jargon, but it has a place, and every sector is unique, right? Healthcare has a language, and airline travel and hotel loads, and like everything has a specific technical language. But you need to think about what drives a business. I mean, oil and gas companies extract a commodity from the ground and sell it for cash. There's a cost to extract it and a cost to sell it, and they make the spread in between. That's it. So it's a physical market. I mean, when we see the oil price on the quote screen, like whether you're looking at the price that you read in the paper is usually going to be the WTI, which is West Texas Intermediate. So that's the oil price at a particular point in Texas. And that's what will be quoted, whether in Alberta, New York, wherever. And if you're looking at prices in Europe, they'll quote something called Brent, which is a North Sea price. And those trade financially, but they're physical commodities. So I always like to remember that it's the physical market. These molecules are essential for life. Like, you can't make anything plastic unless you have components that come from oil and gas. You can't drive an internal combustion engine unless you have something that a refinery makes from crude oil. So they're fundamental physical molecules. And the financial market is super important. But at the end of the day, I think you just need to make sure that you realize what the companies do or the industries do that you're in. Like if you're in biotech, or if you're in healthcare, or you're in consumer products, you can distill it down to what do they make, who do they sell it to, what are their costs, and what's their revenue.
Thank you for sharing that here. And for many of us, we're experiencing all of this on the sidelines, but we get to see all the large price swings or all of these common topics pop up in headlines, which can sometimes feel very, very intimidating for us to understand what's happening beneath the surface. right? Like you mentioned, there's so much different jargons here. So from your perspective, what broader factors tend to shape how these industries evolve over time?
I mean, the big factors are supply and demand, right? If you've ever taken an economics course or even a social studies class, they talk about supply and demand. And when there's more supply than demand, the price will be lower. When there's more demand than supply, the price will be higher. And when things get interrupted, like we're seeing now with a very important transit point for oil, the Strait of Hormuz being essentially shut down, we're seeing some real dislocations in prices of oil around the world, and we're seeing the overall price of oil rise because that situation is happening right now. So those price swings can happen when there's a geopolitical event, when there's some sort of supply event like a fire or a weather event or anything like that. But the key thing is you can look at what the company reactions are, how they plan for the long term, what they're doing about it, and what is happening to the actual molecules. Like right now in the case of the oil and gas that can't get through the Strait of Hormuz, the oil and gas molecules are still there. They're just not in the market they need to be at right now. So there's a disconnect, and price is going to take care of that. There'll be less demand because there's less supply and the price is higher. And we will eventually get through this because the molecules are still there. So I think it's just important, you have to manage your investments in the meantime, but I just want to make sure that we don't get caught up in too much hype and too much trying to clip the top, because again, we just want to be calm and grounded and long-term investors and focus on who's got the assets, who pays the dividends, and where we can make money when we're patient and prudent.
I like how you said eventually we will get through this. So that's a good sign. Some positivity on that outlook there. As we start looking back on your years of experience in portfolio management, what do you think many self-directed investors misunderstand about the reality of long-term investing and when markets move through periods of uncertainty or rapid change? What misunderstanding do you happen to see when it comes to us self-directed investors?
Yeah, I think people worry that they're missing out because again, their friends or their social media feed just talks about the latest and greatest. That's not reality, right? I mean, long-term equity returns are 8% a year, pick a number. And again, if you get that and you compound over long term, you do really well. So just because some guy is giving you big numbers, he's not telling you the bad stuff. We've talked about this before. And you don't get ahead, in my view, trying to participate in short-term fluctuations and being a day trader. I mean, if you want to do that with a percentage of your portfolio because it's fun, go for it. Super fun. But that's a percentage of your portfolio. Hopefully it's a small percentage. And the rest of it is boring and in long-term compounding companies that pay dividends. And I don't be intimidated by the jargon in an industry or the jargon of the financial market, because you can figure it out and you don't have to be able to be an accountant and do some deep analysis of a set of financial statements. I mean, companies produce something called a cash flow statement. So you can take a look at that and just see what you think. And same thing, if you decide there's a sector that you like and you want to buy a fund that invests in that sector, you can do lots of reading about what that sector does and what moves that sector, so that when you see the news, you understand whether it's good or bad or what's going on. So don't be intimidated by not understanding or seeing lots of noise, because the people that are making the noise, a lot of the times, it's not for your benefit. It's just to get out there and get their brand out there and that sort of thing. So just be direct and get the information you need and make a judgment and have some conviction and confidence in what you've decided to do with your money, whether you're buying individual stocks, buying ETFs, buying index funds, buying mutual funds, and then you can follow what's going on and think about your allocation and make some decisions that way, but don't do anything rash or quick, because that's how people blow themselves up.
And as we begin to wrap up this part of the conversation, reflecting on the themes of breaking barriers in investing, is there one common belief or perception about investing that you feel would be helpful for more people to rethink or look at from a different perspective?
Yeah, I think it's important that it's your money and you've worked hard for it. So you want to make sure that it's working for you, and it's a long-term business. So you want to focus on quality and risk management and take a long-term approach to that. And don't be afraid to ask questions, because to learn, you ask questions. And, everybody says there's no such thing as a dumb question. It's true. There's no such thing as a dumb question. Just ask. You'll get an answer. And if you get an answer you don't understand, it probably means the person that you asked didn't understand the topic enough to give you a clear answer. So that's important too. So I would say don't get caught up in short-term noise and hype and what you see on your socials. Just be prudent and confident that you can make good decisions and stick with the judgments that you've made, and just keep reading and learning. And you can invest in your funds or your ETFs or your stocks and have confidence that you're making smart decisions.
And finally, last one coming from me. If you had to describe the mindset of a resilient long term investor in one single word or idea, something that captures the ability to remain engaged through different market environments, what would that be and why?
I would say invest in quality and have patience. It's a long-term game to be successful. Quality never lets you down.
All right, I like that. Well, you heard it from here first, and I just want to say thank you so much for taking the time to go through all of those lovely questions coming from me.